Good evening all. We'll start in about 30 seconds. Wendy, I just want you to check that you can hear us. Just go into questions. Awesome, good to see.
Fantastic. Did she answer? Oh, okay, so she chatted, not answered the question. Hi everybody, how are you? Tuesday night, and we're in the 4th week of lockdown, my goodness. So you've all come out on a rainy night to our little place here on the interweb. And tonight we're so proud because this is a new part of Property Ventures that is presenting this. It's Eastern Bay's property. So my name is Pete Chatteris. I'm involved with the Eastern Bay's property, and we've got Mark Honeybone also as one of the panelists tonight. So Mark, myself, and Wendy will be happy to meet a lot of people of yourselves around the Eastern Bays and maybe further afield. So I'd like to introduce Mark first. We've also got Kris Pedersen. Kris Pedersen is a mortgage advisor, one of the top mortgage advisors in New Zealand. In fact, he's in the top 6 of the largest mortgage broking companies. And of course, Jarrod Kerr. Jarrod is the chief economist of one of my favourite banks, and that's Kiwibank. So he'll be able to tell you what's going on with the dollar and with just about everything else. Might be even able to predict the weather at the end of the week. So I'd like to introduce first Mark Honeybone from Property Ventures. Mark.
Thank you very much, Pete, and very excited to be a part of Eastern Bay's property. Just back to you, Pete, you've lived there most of your life. I've lived there the last 4 years to see such a great place it is with the beaches and cafes and my speciality, the bars. What areas are we covering before we get into the webinar tonight?
You know, Eastern Bays is traditionally the bays leading around from town. So starting with Orakei, then you've got Mission Bay and Kohimarama. So all those places make up Eastern Bays. We've also got places like Meadowbank, St John's, even further afield to St John's Park, perhaps Glen Innes. So it covers a wide area. It's all the bays and the inner areas that are leading out from Auckland City.
Great. So if you're looking at selling, or you know of anyone around there selling, buying, come and see. You'll be seeing more of Pete and myself and Eastern Bay's Property Ventures. So hosting it tonight. So thanks, Pete, and thanks for being the MC tonight. And we'll hear more of you soon. But I'm up first tonight, so I'm the least the expert out of the three, I'm sure. So that's why I'm going to be first. So I'm just going to have 2 slides ready. I'm just talking about what happened last year, we sort of know, and what's going on in the property market now. So that's really what I'm talking about tonight. And just to we go back a year and 3 months ago, I think it was, when it all started. When the last COVID-4 hit, obviously it was all new to us. The market was very similar to what it was now. People probably didn't quite realise it was as hot as it was, or where the market was when COVID-4 started in 2020. We all know now when it started, it's pretty damn hot. And what I mean by hot, obviously there's a massive shortage of stock, and that's the biggest problem. That's what's making the prices go up so crazy at the moment. And there's a lot of buyers missing out. I guess the major difference in 2020 compared with this year, we all know that we're just talking offline before we started, and saying that people aren't freaked this time, they're just getting on and carrying on with business. But last year there was a lot of anxiety in the property market. No one really knew what was going to happen. They didn't know how long this thing was going to go on for. We didn't know what it was. And some of the banks were saying we're going to go 15% and 20% down, and the property market would. I was clever enough to get the Jarrod Kerr on again just over a year ago from Kiwibank, and they weren't conservative at all. They were leading on the edge. Jarrod, you were, and I think you were predicting 10% drop in housing prices, but that was everyone else had more than that. So you were probably closest. But again, it was just an unknown factor. And then, of course, once it happened, we all know what sort of went on after that. So now what happened, and it's interesting to remember for this time around also, what happened last time is, as I said, at the start of lockdown 4 last time, people didn't realise the property market was getting as hot as it was. And in Auckland, it started about October the year before. and October 20 and 19, was it 19? And it had just hit up to a real where the market was starting to go, and the media had finally caught up with it that the market was starting to go, and then COVID hit. So what happened there was a shortage of buyers right then, and then what happened 6 weeks later, or 4 to 6 weeks later, those buyers were still there, and they were really desperate because a lot of those buyers had to move into a property very, very quickly, or buy a property very quickly. In the middle 6 weeks there were another lot of buyers that turned up, and they were, and they're just normal, you know, even though we're staying at home, we still had normal things happen. We have jobs changes, we need to shift for different reasons. So we had a new lot of people in the market. And then of course, the investors were all rubbing their hands thinking the price was going to drop, which didn't really happen. And then of course we had people coming later in the year, people coming back from overseas, back to New Zealand. Now, the Kiwis had come back to New Zealand straight away after COVID hit last year. They weren't the property buyers, they were the ones who just reacted and wanted to get home. But the ones that moved home, I think sort of late last year through to the middle of this year, they're the ones who'll be moving back who are buying, they have got money, and they've also really pushed that market up since. So as we know, last year, the market, once it finished, demand was massive, prices escalated, and I'm going to give you a couple of figures just in a couple of minutes actually that just came out today in REI and Z. But you know, 12 months ago today, the New Zealand market is average going up 31%, which is just insane and ridiculous. Great if you own some property, but not really good for the market. But that's why it was about a year ago when COVID was finishing, or just finished, I think, for us. And now we're a year ago in that same situation with all that growth we just spoke about. If I just click on the next slide. So that sort of brings us on to now. So what's the market doing now? Well, it's hot, and it's I was just before the lockdown, I saw some of the highest achieved prices I've probably ever seen while I've been involved in property. And what I mean, the highest achieved, I mean, incredibly higher than what they were a month or two ago, incredibly higher than CV, and with options, incredibly higher than what the reserves are with options. You know, usually at options, you're battling to get to the reserve and you need it in negotiations. Well, you know, the last 3 months, we've seen options, you know, hang out with some of the best auctioneers in New Zealand, and their options have been going, you know, 200, 300, 400, $500,000 above reserve, which is just ridiculous. So that's where the market is right now. It isn't. It's probably not great because it's too hot, I'd sort of say. Anyway, just working through the points in the PowerPoint. So right now, a bit like last year, it's obviously a vendor's market. There's an incredible shortage of stock. There's an incredible amount of buyers that want to buy. Some buyers that are just, I did a property I listed, and we sold at auction just not long before lockdown, and both the two main bidders were incredibly distraught of missing out, so they're paying crazy money. Interest rates are still very low. Yes, there's talk about going up, and the other two experts will talk about that soon. But they're still low. You still get a 5-year loan for 3% You still know overseas travel, and that's not going anywhere quickly. So you know, people are home, they're spending money on renovating or upgrading or whatever it might be. So there's that also has a bit of a bearing. As I said, buyers are desperate, missing out on some outrageous results at the auctions. Just today, the REI and Z figures to come out, and as I said, 31% increase, which is ridiculous. There's six regions that have gone down from the last month. I just want to bring this to your attention for a reason. Like Northland's just averaged gone from 660 last month to 580k this month. You might go, oh, that's pretty bad. It's gone down $80,000. And the other regions were Hawke's Bay, Nelson, Marlborough, Otago, and Southland. Now, my experience from living in Blenheim for many years, and which all these places, those sorts of places, it's not necessarily the market when month-to-month figures can be distorted, I guess. And I remember in Blenheim years ago, there was about 30 or 40 properties only sold every month. And you sold, you know, 3-4 vineyards were sold 1 month. The average would go up about 200 or 300,000. And then when there was no big sales and there was a small sales, it would drop 50, 60,000. It didn't mean the market had dropped. It just meant that they're volatile, sorry. And because right now there's you know, I think 30% less sales than a month ago or a year ago. again, we're volatile with those figures, so they're not pretty accurate figures. We'll see what happens in the next 6 months, and then we'll find out whether what's going on in the market. But the scary factor for me is 31%. That's pretty scary how that's gone up. So why is the market so hot? I guess I've sort of told you, I guess. But I just want to bring a couple of things, forward, I guess. And right now, I think it's a once in a cycle opportunity right now to list, for example. I'm not talking about tonight about listings, but it affects that's because of how the market is. Right now, you think of investors. There's a lot of investors holding off right now because of the bright line test, and we had, I think, 4 that I knew of in the last 3 weeks before lockdown that were going to list their property, and then they found out it was going to cost them between $80,000 and $100,000 tax to sell their property, so they decided not to sell it. So that's one of the reasons why there's not more properties going on the market, because I think right now there'll be a lot of investors selling right now for a lot of reasons. I think in 2 to 4 years there's going to be a lot of properties come back on the market, but we'll talk more about that in just a second. So the market's crazy. I don't think we ever get a better time to list right now if you are thinking of it. But if I'm crystal balling for the next 2 to 4 years, a few concerns I probably see are interest rates might go up again. The other two will talk about that. Investors, I can see a lot of investors selling their property, like a lot want to now, but they don't want to lose their money because of having to pay tax. You think of all the government rules that come out recently, the healthy homes, the insulation, the heat pumps, the new one, of course, no claiming of interest as an expense, which is staggering. And that's got to be staggered over the next few years coming up. So it's costing investors a lot of money or cash flow right now. And with a 5-year bright line rules, I guess, been 5 years coming up for some of those investors in the next couple of years, then they'll have a reason to sell the property, and I can see a lot of people selling it. That's just my opinion. There's great pressure will be on some first home buyers if the interest rates go up. If they maxed out and the interest rates jump up 1 or 2%, that might hurt them a little bit. And but as for the no claiming interest as an expense, the only business in New Zealand you can't claim interest as an expense, even though a lot of people made good equity with their rental properties great equity in the last few years, you simply can't afford to hold a rental property if you're not getting your $8,000 back or whatever it might be from the government from your interest, and having spent maybe $10,000 or $6,000 getting your property compliant in the last few years. So that's why a lot of people now want to sell their rental properties, just from what I've seen, and that's sort of where it is. So that's my sort of little humble opinion tonight. Remembering me, like the other 2 gentlemen talking tonight, is just our personal opinions. We aren't recommending you race away and do anything after listening tonight. We're just saying our opinions, and this has very much just been my opinion from what I've experienced and seen in recent times, and what I sort of hear people saying every day, being in the market 24/7, every day of the week. So, oh, excuse me. So, Kris and Jarrod, I don't know if you've got any comments or totally disagree with what I've said. What do you reckon?
Just one little point, Mark, that some housekeeping. So you might see a little question pop up, or a question box pop up. If you want to ask some questions, and after all, we've got 3 amazing panelists on here. All you need to do is just ask those questions in the box, and it flicks up on my second screen here. And at the end of the process, we'll start answering some of those questions. So fire away with the questions, because, as I say, we've got 3 wonderful panelists here. And the other thing, I just want to pick up on something that Mark said, and that's about appraisals. Appraisals are very important, even if you're not thinking of selling your house, because your biggest asset probably is your home. And if you don't know what it's worth on the market, then how can you make financial decisions based on that? So come and see us, whether or not you're thinking of selling, or you just want to know the market value of your home. We'd be happy to help you out, Mark.
Okay, thank you.
I definitely agree with your comments on the pre-lockdown market last year. I think looking back, a lot of people, pre-COVID feels like so long ago, that kind of March last year. And I suppose remembering back when you're going through that slide, I remembered how crazy the property market actually was. And it had been kind of going that way for a while. I think all the banks were completely under the pump. And I suppose now we're having the ability to look back, looking at the pure amount of stimulus with low interest rates and obviously, quantitative easing, etc. You can kind of see, I suppose, why the property market's gone the way it has. And I'll be interested to see kind of Jarrod's comments on now, I suppose, how we're going to see, you know, I suppose going the next couple of years with interest rates going higher, not having that same level of stimulus going from here.
Yeah, I think the key point that Mark made was around the supply of the market. You know, this time last year there was an undersupply, a shortage. We'd modelled it of around 100,000 homes. Population growth has slowed, obviously, with the borders the way they are, and we're seeing a bit of a construction boom. So that shortage is slowly being eaten away at, but we still estimate it to be around 70, 80,000, which is the entire Hawke's Bay. So the first thing I look at when I look at a housing market is it oversupplied or is it undersupplied? You know, you look at Australia, parts of Australia, it's oversupplied, rents are falling, prices are falling. Here we've got an undersupplied market, rents are rising, prices are up 31%. The last time we had a market that was this undersupplied was in 2003 and prices rose 35%. So, you know, we've got a similar situation happening here. It shouldn't be too much of a surprise. The only other thing that can really blow it up is you know, a recession and unemployment rates rising, and we're not forecasting that this year. We were, as Mark said, forecasting that last year. So yeah, that's the big difference, but that undersupply is still a problem.
There's also obviously all of the supply chain concerns coming through in regards to materials and things like that. Do you have a concern, because we're obviously hearing prices going through the roof there and just the pure inability to get your hands on materials, that there's a risk that while there's a lot of consents coming through, a lot of those maybe smaller developments won't actually get off the ground?
Yeah, whether they don't actually get off the ground or whether they're just postponed. Yeah. You know, I think postponed is the obvious answer. Hopefully they get up off the ground later on, because we still need a lot more supply to come. But yeah, we've got a lot of clients who are tearing their hair out, and you know, there's problems with pricing, but you can almost handle some of that. It's when you don't physically have the product to bang up on the wall that you know, you get costly delays. That's what really hurts, is the delays.
Because we're starting to see some of the financing in that part of the market pull back as well. I think purely because of concerns again around supply chain pushing up pricing, throwing risks around obviously lockdowns, pushing out you know, basically completion times and all that. We've heard some of the banks are basically pulling back in their development units. Some of the finance companies are now getting concerned with their level of exposure. So it'll be interesting to see how it plays out, because while we might have a demand to get some of this stock out there and built, there are some restrictions going on behind the scenes as well.
Have either of you seen a few blowouts with developers? I don't know how close you work with them, but yeah, a few blowouts with the cost going up so much in the last 12 months of building products.
It's more probably in the finance company market. They're pretty well controlled through the banks. There'll probably still be some cases where they're blowing up, I'm sure, in the bank's property finance units, but I think it's more a case with, yeah, there's definitely some where there's been massive delays, things like that. Obviously, there'll be some, I say, developers who'll be tearing their hair out with how much each week of lockdowns cost them at the moment.
Yeah, absolutely.
No,
Okay.
no blow-ups at my end, but I have heard, you know, on the contrary to that developers were sort of putting their hands together after the government changed those interest deductibility rules, and found themselves with a bunch more investors wanting to go into new builds, which I think is exactly what the government wanted, and it seems that that's where the demand has been nudged.
100%. We think that's definitely our business being so focused that overnight went from probably people going from second-hand stock into new builds.
Yeah, and even a lot of the what I call the old school investors who were never ever going to buy a new build have certainly jumped on the bandwagon as well now. And the government just made it so hard also to own a second-hand product. It's pretty difficult. So that's the demand now for new builds is massive. It's incredible. We can't find stuff now for them, and of course there's quite a few trying to get built. So be interesting to see what happens in the next sort of 6 months, and hopefully this COVID doesn't go too long so we can actually get on and keep building and what have you. Right, well, I think we might as well move on to the next speaker, and I apologise, Jarrod, for the first slide. I couldn't quite get your Kiwi build thing to work. Your rest of the slides are as they are, just only this one here.
That looks great, mate. It's the right colour.
You. I'll click away.
All right, well, thank you. My job's to set the scene, if you like, to try and cover off on where we see the economy and how that relates to the housing market. The main point I would like to make is that we really did run into this lockdown. We were running at a pretty fierce clip, you know, right up until the lockdown. The economy was performing particularly well and with really strong momentum. So we do believe we're going to sort of bounce out of this lockdown quite quickly in the fourth quarter, and then we'll be looking to quite a solid year, hopefully, next year. The other point I'd make is the one I also made this time last year, is that we always underestimate the adaptability of business. And we've noticed that quite particularly this lockdown. You know, if I think back to the last lockdown, the first one, we were receiving thousands of phone calls from distressed businesses and customers just not knowing what's going on. And they adapted last lockdown. We put out more FPOS machines than we've ever done in Kiwibank's history. We got people onto credit and debit cards. We, you know, got contactless payments. There was a lot of adapting going on last year. This year, we're getting hundreds of phone calls. So and the businesses that we're talking to are just chatting to us. They're very calm. They know what's going on. There are some that are obviously distressed, you know, cafes and a few restaurants and the like, but most Kiwi businesses have adapted and are kind of cruising through this, for lack of a better term. And I think we are going to come out of this in very good shape. So yeah, if we just go to the next slide, thanks.
Oh yeah.
Now, from an economist's point of view, from a Kiwi economy point of view, we've got a really large export sector. So it's great to see what we call our terms of trade at record levels. Now that chart goes back to 1861. So we've got a fair amount of data here. And what it shows you is our export prices relative to our import prices. So we're getting paid well for our exports and relative to what we're paying for our imports. That is an income injection for this economy that we don't often talk about. Obviously comes through the big exporters, but it's a big positive for a little open economy like New Zealand's. And on the chart on the right there, I just wanted to highlight right up front, I think the Kiwi dollar is actually undervalued right now. You know, a Kiwi dollar around 70, 71 cents is actually quite cheap compared to where our fundamentals suggest it should be. So for anyone overseas looking at investing in New Zealand, the currency is not an inhibitor. The currency is not expensive, and New Zealand's not trading expensive in my opinion. So this is a very good sort of starting point, and it reflects quite a lot of demand for our product globally. Let's jump on to the next one. Now this is what we think is going to happen. Now Mark gave you a pretty good warning as to what to think about economist forecasts. What happened last year was that big dip. What we're expecting to happen now is that smaller dip. So we had a contraction of GDP of around 11% last year. We're expecting about 7% this year, but an even faster, quicker, more savage bounce back in the first quarter, and then away we go into next year. The main point here is that we're actually in a better position today than what we were before the first lockdown. A 30% or 31% rise in house prices certainly helps. A really tight labour market certainly helps. But more importantly, there's a lot of confidence in business. If you just jump to the next one, please. So the chart on the right is probably the most important. This time last year, companies really did panic, and they started pulling back on their intentions to invest, pulling back on their intentions to expand. This year, we've seen that confidence return. We've seen investment intentions pick up, and we're actually seeing a lot of businesses trying to automate and get their businesses ready for a market with tight labour supply. Because if you look at the next chart, the difficulty in finding labour is as high as it's ever been. And we know that this is due to the border closures, but one of the biggest problems businesses are facing today is trying to get workers. Now, at the mighty Kiwibank, we're the same. We're struggling to find IT people, call center people, right across the bank where we're looking to hire. We're getting some jobs filled quite easily, others really struggling. And when I was traveling around the Hawke's Bay and Whanganui and in the South Island, most of the complaints I heard from businesses was that they just couldn't find the right people. Now, on the flip side, from a household's point of view, an unemployment rate as low as it is, around 3.9%, is fantastic for job security. It's fantastic if you're looking to invest in a house. The biggest way to stress test a housing market or to stress test a bank is to put one of those unemployment rate scenarios to us and say, right, let's pretend the unemployment rate goes to 9%. What does that do to your bank? Well, unfortunately, the last few times that that's happened, we've seen a spike in defaults and we've seen house prices fall. No one's forecasting that this time. That was last year. This was what we thought was going to break the housing market, and it didn't happen. In fact, what we've seen is the labour market has actually tightened a lot faster and a lot harder than we had envisaged this time last year. So the fundamentals of the housing market with the shortage, but with also very strong labour market is really important. If we get what we think in this scenario here, I find it hard to believe house prices will fall, like some of the other economists are actually calling today. What's the next chart? And with regards to population, this is the interesting bit. Obviously, with our borders closed, eventually we're going to open ourselves up. Eventually, it might not be a 2022 story, but it might be something in 2023. Now, our modeling suggests that migration will bounce back. You'll see that little swish higher in the curve there. What that means is we're going to see Kiwis leave, but we believe we're going to see more foreigners want to come down to God's country and jump into our very tight labour market and pick up a really good job. So we believe net migration is going to be positive, and that again will add some demand to housing from sort of 2023 and beyond. And the next one. We did a regional report, which was a lot of fun, going around the regions, talking to all our mobile mortgage managers and business managers, and basically everywhere came back saying we're running red hot, and most of this was on the back of their housing markets. So what's interesting about this particular house price surge is that it really is across the whole country, and you're seeing 50% plus house price gains in the likes of the Hawke's Bay, Gisborne, and some other parts of the country. That's feeding through into their local economies, and just about every part of New Zealand is running red hot with scores of 9 and Wellington at 10. That compares to this time last year, which was that blue chart just underneath, where everything was cold and we're all worried and panicked. You can stay there, that's fine. So with regards to house prices, what we're expecting, well, house prices are currently running at 31%. We do believe that interest rates are going to rise. We do believe that the cool down in population and the lift in supply will take some of the wind out of the sails, but it's really the changes to the LVRs, the government's rules on interest deductibility, the threat, and I think likely implementation of DTIs, debt to income ratios, that will take a lot of the wind out of the sails of the housing market, but we're not forecasting a contraction. Now, if we can just flick through a couple of slides, I'll just talk to interest rates here. Next one. Yeah, that's the one. So the RBNZ is looking at the New Zealand economy right now and going, right, on the one hand, we have inflation running at the top of our band and likely to be quite hot for a while. And on the other side, we've got a very tight labour market and wages are rising. Now's the time to take some of the policy stimulus off the table and lift interest rates. So what we're going to see is an interest rate which is at a record low of 0.25%, so 25 basis points, and it's going to rise to about 1.5%, I believe, by this time next year. And that's basically what the Reserve Bank of New Zealand's told us they want to do. They've actually said that they're going to probably keep going to 2% over the next few years. What does that mean? It means that interest rates that you're facing today, they've already adjusted higher in anticipation of this, but they will continue to ratchet higher as the central bank lifts the cash rate. And I'm happy to debate this point, but I'll open it up and we'll have a chat, shall we?
Right on that point right now, or after when you finish?
Yeah, why not?
Yeah. Well, one question I was going to ask: would you think that is COVID going to just slow that down a little bit from the interest rates when they were going to go up, or because the base points were probably going up a few weeks ago, weren't they?
It's a good point. They were supposed to go in August, as you say, but they postponed and said, well, we can't really go at the same time the country's going into lockdown. But they've come out and said quite adamantly that even if we're in, level 2, level 3, somewhere around there, we believe the economy is in such good shape that we'll be able to lift interest rates. Now, I know it sounds quite funny, but we want interest rates to go higher. And when I say we, I mean all of us, because interest rates moving from record lows to something closer to a new normal means that the economy and the housing market and everything is performing well and doesn't need that support anymore.
If I remember correctly, I think you wrote an article last year when you weren't that much in favour of negative interest rates when the RB was talking about that. Would you like seeing us getting a little bit more gas in the tank in case something comes along in the future?
Sorry, what was the second part of that? A bit more gas?
I'm presuming you'd like to see us get a bit more of a buffer. So of course, if some shock comes along, we've got something there.
Yeah, completely agree. Absolutely. We are in a situation where I think the market can handle, a 1.5% move in mortgage rates. From here, it's not going to break the market. It's just going to normalize it a touch. There are a bunch of people out there who have never seen a rate rise before. They're going to be introduced to a small rate rise over the next year. I don't think, if we've done our jobs right as banks and lent them money appropriately with a floor of 6%, which most of us apply, that means that everyone who comes to a bank, get a mortgage, should be able to service it at 6% interest rate. We're not going back to 6%. We'll be going back to the mid 4s. And you're absolutely right. I was very much opposed to negative rates. I thought that would have just destroyed savers.
And I mean, I obviously the last OCR review was the first day of lockdown, and my understanding is the markets had already pretty much priced in the increase leading into lockdown. How much? So we've seen a lot of clients who've been considering breaking and refixing for longer terms now. Is right now a pretty good time to do it? Well, we've still got obviously the country's engine room in lockdown potentially before we see some of these further OCR increases come through.
Well, I think it's definitely a good time to have a conversation with someone like yourself. I can't offer personal advice, but I can tell you what I've done personally, and I've locked all of my mortgages out 3 to 5 years. Yeah. And I don't get it right all the time. I did the same thing in 2018, and not all of that worked out. But for me, I see these interest rate rises coming, and I just want that certainty. I want to know that I'm paying 3-4% on this investment property. Forget about it. I'm receiving this rent and I'm paying that interest. I like it fixed.
Yeah, it seems to me while there's still some attractive short-term rates in the 2s for the 1 to 2 year, it seems to me for most people, not all, to kind of common sense to go to mid to longer term rates at the moment.
One question for the panel is, Jarrod, you talked about the Kiwi dollar being higher, and I think, like you, it could go higher. I watch the Forex markets quite a lot. What is increased rates from the RBNZ going to do to that Kiwi dollar? Is it going to propel it higher? And if so, what does that mean for exporters and importers alike?
Yeah, so if we're right, I showed you one chart with the terms of trade. Another really good chart is interest rate differential. So what our interest rates are relative to other countries, that's a big determinant of the currency. And if we get a central bank here tightening from October and November and February, then we'll see our currency rise relative to the Australian dollar, relative to the US dollar, euro. Actually, I think most currencies will find ourselves relatively well supported because RBA doesn't want to lift interest rates for at least another 2 or 3 years. The Fed in the United States is the same. ECB is a 4-day camel trek away from even thinking about it. So, you know, we're sitting here in quite a privileged position where our central bank will be the first developed market economy to go, and I think that'll put upward pressure on the currency. That's obviously not going to be liked by our exporters, but as I showed you in that chart, they're getting pretty good prices for their products, so it'll just dampen that a little bit. And for importers, well, that'll actually alleviate some of the problem that Kris was mentioning before, right? You got this shortage and higher costs overseas. If your currency actually can buy more per dollar, then that'll help a bit.
So are you possibly saying that we might finally get parity with Australia?
We have. We got it overnight, and I mocked all my Australian friends. Yeah, we did get it for just one night, and I want to get it again, but actually hold on to it for a month or two. Get out the parity party.
Nice.
Yeah, I saw it at 90 cents, but I didn't realise it went up to parity. That's good news. You know, it's like the All Blacks versus the Wallabies, really, isn't it?
Yeah, we've done it once. We can do it again.
Yeah.
So I'm happy to carry on with Kris if you like.
One quick question before I talk. I noticed on one of your slides, I think it was slide 10, you had a employment graph, and especially skilled labour was going through the floor. I did note, except for the large spike, which I presume, can you zip back to slide 10, Mark, just quickly?
What one, sorry?
Jarrod's got his slide numbers down the bottom right. Can you just go back to slide 10?
Yep.
Yeah, this one. So off to the right, I just want to make sure I'm reading this correctly. We've got obviously the dark green line being skilled labour getting tighter and tighter. I'm presuming the spike is lockdown last year with certain employers making a decision they regret now because they'd like to get those people back.
No, that's 2009. Oh, sorry, that initial spike. Yeah. No, that's right. Yeah.
And just having the part that surprised me is following the green line down. It almost looks like it would have actually got pretty close to where it is now anyway without that change. So were we probably going to be in this case anyway, even without COVID?
Yes, I think so. But there's a few, we've changed a lot thanks to COVID. So there's a lot of things that I think, there's a lot of, I think, silver linings with regards to companies automating and getting more online. That really has, what we thought was going to take 5 years has been condensed into 6 months effectively. So there's that technology side has definitely advanced a lot faster, but just looking, as you say, that trajectory there without that blip, yeah, we would have kept tightening.
Roughly there anyway, yeah.
Yeah.
Yeah, no, we've definitely seen the same as what you were talking about, is that it's even hard to get a CV crossing your desk at the moment with how tight it is out there.
Yeah.
Thanks, Mark. You want to jump onto my slides?
So, what slide are we going to?
One question that Mark, you might be able to answer a little bit is that obviously new builds are very attractive to investors because of the new tax laws. But there has been talk about different materials coming in, prefabricated houses and 3D printed houses even. But the government seems to be reticent against that. What are your thoughts on those alternative building methods?
I don't really know. I mean, I've seen that come up in the last 20 years often, and there's these prefab type things, and some go, I think they're okay, but none have really, what I've seen, have taken off and gone to the next level where everyone's just gone and brought them. Minor dwellings and stuff are okay, but I know I've seen a lot of big companies come in where people got really excited about a cheap product coming in, and it might be what I've never really seen any of them take off. There probably are a couple that have. I just haven't really seen it myself, but what that means, who knows? It might be someone comes in, but it's got to be something that's so bloody expensive to build. New product, good new product right now.
I really hope that Kāinga Ora can break that. We've got one large entity that has the scale in order to do something like that. So most large builders that I talk to are talking sort of 200, 300, 400 houses a year, and they're big, right? And you talk to them and you say, for you to get into prefab, what would you need? And he goes, I would need to set up a massive warehouse, all this technology. I would need at least a guarantee of 1,000, 2,000 homes to make that profitable.
Well.
Whereas Kāinga Ora does have that, and I think they need to be the ones that would lead in that space to really break the back of some of the costs that we have in our building. Yeah, sorry, Mark, I'm an economist, mate. I've got like 50 slides there. You might have to jump through a few more.
Do you want to talk through some of these, or you just?
No, I just got them there just in case they came up in questions.
Oh, good.
Do you think
okay,
that prefabbed and ago?
Sorry, can you say that again? You were breaking up a bit.
With the increase in Kiwi dollar, perhaps the prefabricated entrepreneurs might have a in.
Yeah, but like I said, they need that scale. I've been to a couple of prefab conferences, which I really enjoy actually, and all the technology's there. And there was an Australian crew who showed us that they built an entire hospital in some outback in Australia in like 30 days. It was just, bed after bed after bed, just slapped it all together, bang, done, and quality job. I don't see why we can't do it here, other than the fact that we are a nation of really small companies.
Yeah, we spec did a trial a couple of years ago on it, and never heard anything since. I think they were doing half a dozen houses through it, but never heard how it worked. And I think there's obviously, I agree with you with the Kāinga Ora, getting them behind it, they could actually pump them out. And the private market, there just doesn't seem to be the infrastructure yet to support it from a funding point of view.
Thanks, guys.
So I'll let you obviously take the slides over, Mark.
Yep, okay. Rightio.
So just a quick, I suppose, lockdown, update, and then I'm going to have a bit of a talk about DTIs, as I think we've already covered interest rates. Jarrod's covered that in quite a bit of depth. So as Jarrod himself basically said, it's been really business as normal. Last year, we found going into lockdown, we didn't really have any standard mortgage inquiries at all. Everyone was querying around, could they get a mortgage holiday? Could they get interest-only relief? Most people at the time didn't actually need it. They were just educated enough, I think, to ask for it and get prepared, obviously expecting the worst. This time, we've just been swamped with normal inquiries. And you can even see through the media, there hasn't been the same talk around mortgage holidays, clients going on interest only really quickly. I think the expectation's been that people need to kind of get through it and not use the same relief they had last time. And I don't think there'd be the same appetite from it or for it, sorry, from a Reserve Bank point of view, because obviously a lot of clients grabbed it last year and a lot of people need to start paying principal, obviously, and get used to making mortgage payments again with the expectation of these interest rate rises. Something else we saw last year, some of the banks got really picky on occupation type. Obviously, those kind of risky or perceived risky areas around retail, hospo, tourism, etc. We found for a while they're quite hard to get people's mortgages across the line. So far, we're not getting any of that questioning. Obviously, got to wait till the other side of maybe Auckland's come out to see how that plays out. But we're just not seeing the same concerns at this stage come through from a banking point of view. We discussed a little bit earlier in regards to development, there is starting to be a few concerns come through there. Seen a couple of the banks start to pull back and say they really only maybe want to fund their existing developers on the books and maybe not take on too many new developers. And this is going back to some of those supply chain concerns that we were discussing earlier, and definitely seeing some of those same concerns come through in some of the bigger non-bank specialists who play a lot in the property development space. Something to be aware of behind the scenes, it looks like a bit of an acronym and jargon that won't mean too much to any of you, but the triple CFA. And what we're finding is funding is tightening, and there's a lot more regulation coming in behind the scenes. An update in the triple CFA was supposed to come in on the 1st of October. And as of last week, it's actually been pushed out to the 1st of December because of issues around this lockdown. And be aware what it's going to mean is that, say, mortgage advisors such as myself, or if you go bowling into the bank yourself, you're going to get asked a lot more questions than what you were previously. And this is on the back of, say, issues coming out of a Royal Commission over in Australia, and just basically lenders having to take, I suppose, more responsibility. In my opinion, it's just going to make it harder and harder for probably people who are pretty financially responsible to actually get their hands on money. And it's designed to look after vulnerable people, but it's unfortunately going to make it harder for everyone to get their hands on a dollar when they're borrowing. So just be aware, if you're out there in the market, we're probably going to come out into a pretty busy market on the back of this lockdown, and that's naturally going to create a bit of stress, as we sort of saw last year. You're going to find these changes, especially running into the Christmas season, are probably going to add even a bit more stress. And so the turnaround times and everything are just going to get pushed out. We're already hearing a lot of cases over in Australia where it can be 3-4 weeks to basically turn a mortgage around. And I think some of these changes that we're starting to see come over this side of the ditch may mean that we see some of those times blow out as well. So besides that, I want to have a bit of a talk about debt to income. As per what Jarrod said, I agree with him. I'm pretty sure that there's a pretty good chance that this is going to come in at some stage. Grant Robinson gave the Reserve Bank the ability to use debt to incomes earlier this year. And my understanding is in October, they're starting the consultation process, whether to look at debt to incomes, or the other option is what they call interest rate floors, which would definitely be my preferred option. So the banks already use that. If we're discussing about interest rate floors, Jarrod referred to it earlier, where most of the banks are kind of using a test rate of around 6%. And I think that's probably a pretty good way of keeping things at the moment, rather than messing around with too many other factors. You could probably move that up a little bit further, further if you wanted to slow things down. But I want to give you a bit of an idea of how debt to incomes could look, because we've actually already had ASB introduce them. And we've been seeing ASB quite a bit over the last 6 months because they brought out a very aggressive build product, about 1.79%, which was attractive. At the same time, we found out how preventative the use of a debt to income tool was. So I thought the easiest way to show this was a couple of examples. So if you want to flick this over, Mark, this is a small investor. So let's say they had a household income of a couple hundred K. They had existing rental income of 52,000, and they were buying another rental which was going to return them another 26K or $500 a week. Their existing position is $1.4 million of mortgages and 20K of credit card limits. So just remember 1.42 mil of existing debt, and they're basically looking to take on another 800,000 to purchase this new property. So this is a basic idea of how banks have been looking at affordability behind the scenes. So you can see the 200K earned income. Let's say they're on 100K each. That translates across roughly to 6,224 per month each. Taken the weekly rental income of $1,500 per week, put into a monthly basis, and then the banks have been taking 75 to 80% of that into consideration. So standard bank servicing means they're getting a touch out over 17,000 into their hands, which is what a bank would take from an assessment point of view. Now, how the banks have been assessing mortgages is on the next slide. And what you can see here is the existing $1.4 million plus the proposed new debt of 800K. And as we've said, banks kind of tend to work off a higher test rate. In this case, we're using about 5.8%, and they assess everything on a principal interest basis, even though you might decide to have some of your debt on interest only. And that's then translating to those numbers down the bottom right-hand side. And so even though in reality, especially if you had some of your debt on an interest-only basis, you'd be paying a lot less than this, you can see the bank's got a nice safety buffer in there. So that's what they take into consideration. So can you flick to the next slide, Mark? So then what they do is they look at the rest of your situation, take into account things like credit cards, living expenses, maybe other external expenses you've got like insurances. And right at the bottom, you can see that this particular client's got a surplus. And so there's a pretty good chance, all of the things being equal, they're going to get a nice big tick and they're going to be able to kind of buy that property. When you're ready, Mark. Yep, and then the next slide.
Oh yeah, sorry.
So that was an example of how the banks had roughly been working servicing out. This is how ASB is doing it with a debt to income. So they have actually scaled their rental down, so they're only taking 60% of rents into consideration. So the 78,000 per year was the existing rent plus the new proposed rent. So they're taking 60K, plus they add the gross earned income. So we're now working with a figure of roughly 247,000. Then if you have your own occupied property secured at ASB, they're timesing that by 7. And so you can see the total figure you can get across the board, even if you've got some debt with other banks, is 1.727 mil. If you don't have the own occupied property, you're capping out around 1.848 mil. Now keep in mind, as I said earlier on, this client's already got total debt exposure of 1.42. Keep in mind they were trying to basically kind of borrow another 800,000 to purchase this new property. And you can see, especially if they didn't have their own occupied property at ASB, they're nowhere near it. They're still a long way off, even if they do have their personal residence there. So you can see this particular person, they can go out and pretty much off every other bank, excluding ASB in the market, get across the line. With the DTIs, they're shut out. Next slide, please, Mark. So this is a large investor, and this really gives an example of how it's going to hit those of you who maybe have quite a bit of borrowings. So this particular person came to me, they had all of their debt with ASB, and they've been building their portfolio up over about 20-year period, substantial portfolio, hit a brick wall for the first time ever, and I guessed why, and then I've been working the numbers backwards with them. So gross earned income of 366,000, obviously a large portfolio generating a touch under 1.3 million rental per annum. Large mortgage portfolio of almost 16 million, and a small credit card there as well. I'm going to jump to the next slide, mate. So keep in mind, ASB had given this client $16 million in debt facilities. Now, if we put their new debt to income rules over the top of it, this is how it would look. So annual rental times 60% plus their earned income comes to a touch over 1.1 million. Times that by 7, and that means they couldn't borrow 8 million through ASB now. And keep in mind, ASB has already given this client 16 million in facilities. So if this client decided to extract their personal residence, that borrowing is going under 7 million. So you can see here already the introduction of ASB's debt to income rule has basically halved this client's borrowing capacity. Now, just can you flick the next couple of lines, Mark? So you can see here, roughly, they would only be able to borrow with ASB about 7.8 million less than what they currently have now. We've actually managed to pull an approval out of another bank this week for this client, because other banks, of course, haven't introduced debt to income. So I've done quite a bit of analysis, and we still think with this client, we could get another 6 mil across the line based on the current lending criteria, all through banks. So this client can get to 22 mil in the current environment, with debt to incomes, they're kind of somewhere around 30-35% of it. So just be aware. I suppose jump to the next slide, Mark. There's some pretty big implications. A lot of investors, may not be able to borrow further through banks. Keep in mind, if you've got a portfolio where you've got a number of properties with one bank, if you get into a bit of a cash flow situation where things are a bit tight, banks more and more are making you fit their current criteria at discharge, which means if they're going to put these DTIs over the top and you sell a property trying to get your hands on some of the sale proceeds, you might find all of those sale proceeds are actually getting put onto remaining debt. So you may not actually get the proceeds. Also, more and more clients, of course, are having to go through new loan applications to roll interest-only periods over. And so DTI is going to make it harder and harder to do that. So if things like interest only is important to you, you want to start having a look at your cash flow, because if you're going to get forced onto principal and interest, now might be the time to look at reviewing your portfolio and rejigging it, before these potentially come in. So that's pretty much me. I did have a, I suppose, question to start off with Jarrod. I suppose your opinion on how you see these things.
Yeah, I think you've gone through it really well, really well. I think this is the DTIs will have the biggest impact to date. Yeah. I thought the LVR restrictions were very strong, particularly compared to overseas. But then putting this on top, I think that'll be the probably the biggest headwind for housing to date. And you showed the big investor versus the normal size investor, I guess, and then you've also got first home buyers who, if they were part of this, would be hurt, I think, even more. But I would imagine they would be exempt. But yeah, no.
Any risk of them not exempting new build?
I don't know. Good question.
Because to me, that would be the biggest mistake they could make, is not exempting new build, because we know that there's been a huge amount of, especially the first home buyers or even investors, to be fair, who have been buying properties off the plans over the last kind of year or two. It's a way to get into the market, and a huge amount of them can't get finance until close to settlement. So the risk is that people have been signing up properties, of course, based on previous finance rules. If they don't exclude new build, there could be a whole lot of blood on the floor.
Right.
So one question I've got is, obviously a lot of investors, I'm not sure what percentage you know or think investors might be affected by that, can't get finance. That might have been. How does that affect first home or home buyers as well? Who's going to be hurt more, home buyers or investors? I imagine home buyers, because they haven't got any rent to back up their income.
I was having a discussion with someone about this the other day, and in some ways it's a hard one. I don't actually know. I don't know. I mean, overseas, most countries who use debt to incomes actually exclude property investors. So here, if we look at what Grant Robinson's wanted to do, he actually wants to basically exclude first home buyers and hit property investors. Now, the reason I believe property investors are excluded overseas, if we actually look at what a debt to income does, it actually takes into consideration your living expenses, because it's behind the scenes, it's part of the formula. Well, if I go buy another investment property, I don't get another set of living expenses that goes with it, which is part of the reason it's been excluded. But I still look at it as being quite a coarse tool. I haven't looked at the numbers enough, but I'd say it's, in a place like Auckland, it could actually potentially cause some damage if it's not implemented correctly. Whereas there's maybe other areas of the country where the multipliers maybe, it could be used quite well to rein certain things up. So I think at least the Reserve Bank's come out saying that if they go down a debt to income road, they're going to try and consult for quite a longer period. Whereas if they go the interest floor route, they can probably bring that in. They've already kind of got that there. I believe over in Australia, that's already regulated. So I think it'd probably be quite easy to come in and go, all banks have to have a minimum of 6.5% as an example, and just push that through, because it's something the banks are very used to. They can just change their internal servicing calculators. That doesn't worry me. DTIs does concern me, and it really concerns me with the amount of people out there who probably aren't on top of their personal finances enough to know that if their interest-only loans are all forced onto principal and interest on the top of higher interest rate hikes, on the top of losing, tax deductibility, the accumulation of all those things hitting at once could become quite painful.
One thing you said is a little bit alarming to me is, with the real estate head on with the buyers, is and I'll say get into your broker or your bank as soon as you can and get a pre-approvals, because It's going to take, I know how hard it's been and how hard you guys work this last year or so with how long it takes to get some deals across the line, and it's not your fault, it's just the banks take a while to get through the process of approving these loans, whether they're understaffed or just too busy. But yeah, if it's going to take 3 or 4 weeks, it's hard because you're in a hot market where you compete against others, and of course you try to lessen your clauses to give you a better chance of buying the property, not only the price. So that's going to be interesting times and a lot of headaches, I imagine, for you guys with that. It'll be something to think of as an investor when they go in. 10 days finance might not quite do it for a wee while.
I think, to be fair to all the banks, they were breaking at the seams prior to last year's lockdown, and then to basically go into it with the absolute head of steam that this property market's had, plus going through the skilled labour situation that we've been discussing before, that they just can't get staff to basically prop that up, has meant that it's been a pretty full-on year for, I think, anyone on the property or the finance markets. And I think we come out of the Auckland lockdown, and that's going to be a pretty crazy run into Christmas as well.
One of the things that we noticed in the Eastern Bays is there's a lot of people, particularly first home buyers, that haven't thought of going to a mortgage broker. And to me, that's pretty crazy. I mean, we get people who say, well, I work for the bank, so why would I have to go and see a mortgage broker? But the first thing that we used to tell every new home buyer that we dealt with over the last 2.5 years is go and see a mortgage broker first. Some thoughts on that, Jarrod, from a bank's point of view?
Well, I mean, it's all about financial literacy and financial education from our point of view. And brokers get a lot of things done for us, right? So by the time you guys have spoken to your clients and you present them to us, you've filled out a lot of the boxes for us. You sort of obviously help the process. So brokers are a very important channel for banks, but from my point of view, it's about that financial literacy. It's about that awareness, not just sticking with the same bank, but actually having a look around. A lot of people would come up against a roadblock like that one mentioned from the yellow Teletubby, already doing DTIs, and they would walk away and go, gee, I can't do it. Well, actually, you speak to Kris and he'll put you in touch with another bank that can. Yeah, I think that's the key message.
Right.
Yes, it seems to be that a lot of these first home buyers are coming back to us saying, well, we didn't know a lot of things, and the mortgage broker, of course, is that conduit between ourselves and the banks.
Yeah, I would just sit there and go, for anyone who's probably getting finance, and probably alluding to what Mark's saying before, is use, especially if you're in Auckland, you probably might, have a couple of spare hours if you're going to get into the property market. If you've got a settlement coming up in the next 12 months, use it to get your pre-approval across the line. At least it will probably cover you, potentially if there is something like a debt to income change. And so it's just worth kind of getting that in place.
Pete, you might better raise quite a few questions have come up. We better start asking some of these, I guess.
Yes, we've got a few questions there, Mark. I mean, most of it is around the economy, and where it's going to go. There seems to be a thought that the economy is going to bounce back like after the first one, but there are some people that are very reticent, and some economists who are also very reticent to predict that. We've seen the slides, so what are the hard factors that the normal person in the street can understand about where the economy could go?
Well, it's a good question, and it comes down to that point I made about confidence, and I think confidence is key. Confidence today is so much higher than what it was when we were all panicked for the first time this time last year, economists included, right? We had no idea what was coming. We were making forecasts based on assumptions that we were going to be in lockdown for 3 to 6 months. So that's why we were predicting, quite savage outcomes. Here we are, most of us are reasonably comfortable that we're going to be out of lockdown level 4 next week. And then a few weeks later, we'll be out of level 3, maybe we'll be at 2.5, probably towards Christmas. Whatever it is, as soon as we're out of level 3, the economy goes back to 97, 98% capacity. So right now we're Auckland region's running at about 95% capacity. So it feels a lot worse, but there is a lot of work actually getting done at home. And I did have some slides in there for anyone who's interested, showing the Kiwibank transactional data, and it's all dropped as you would expect, but starting to bounce back outside of Auckland again, as you would expect. As they went into level 3, level 2, bang, you're seeing spending outside of Auckland bouncing back. So the hard facts, the high frequency data, suggests that we're on a similar path to what we saw last year, which was a V-shaped recovery.
Okay.
Right.
And
I've got a question from Paul. I'm not sure if you covered it on. Oh, yep. Sorry, Pete.
Your thoughts on that, Mark and Kris? As far as the economy bouncing back. I mean, okay, so one thing that I've noticed as an agent on the ground is that winter traditionally has been a very slow time for real estate. I mean, we all know that people don't want to get out of their beds and go out and arrange open homes and that sort of thing. But leading up to level 4, it continued to be very strong. So I would agree that after the lockdown ends, you've got that rush of people that haven't been able to buy after the lockdown. You've got the economy good, and you've got low unemployment. So, I can see the market really raising. The problem is, as it's been for the last year or so, is supply. The demand's strong, but the supply is weaker. So, that could affect things. And it's all the more reason why you need to phone us and get an appraisal done.
We'll just go through a couple more questions here. Paul's asked, I'm not sure if you answered it or not, Kris, when you think the RBNZ, the Reserve Bank, will start applying DTIs next year? Do you know when?
So consulting on it from next month. They've said that it's going to take longer to go through. The big thing I'd say is, as we've seen with the RB using LVR changes before, besides 2015, where they gave the market quite a bit of notice of a change and then probably regretted it, I don't think they're likely to do that. They're more likely to probably get to a stage and maybe implement it relatively quickly, as long as it doesn't have too many negative connotations to borrowers. I think they've found previously, by giving too much lead-in time, people just go absolutely crazy for a period of time leading up to that. So to me, it's a case of I'm more trying to base it with my own investing and with clients. I'm more going into it from a situation of it's probably coming in, and recommending you adjust your portfolio based on that, especially in regards to looking at things like if you need interest only to be able to survive from a cash flow point of view, if you were going to have to sell, etc., would you be wanting the sale proceeds? And if you're fine and you basically run, I suppose, a bit of a stress test over your portfolio, and you're looking at going, you're fine, well, don't make any major moves. But if you're sitting there and a bit of an interest rate rise and a move to P&I is going to hurt you, you probably should be kind of making that decision sooner rather than later.
Yeah. I've got a question here actually that's sort of aimed at me, but I'm really interested to see what you say, Jarrod. This person obviously heard me at the RPA meeting I did last week, and I was talking there about if you have one of the strategies I use now, if you have earn good income or you have extra good cash flow because of low interest rates, of putting more money back in the deal, more money back on your debt that you have, or paying P&I. And it's a bit different than I got taught 15 years ago, never pay debt off. And because of, for me, increases cash flow, you have less debt, there's less debt, there's less risk, and the sooner you're in a good position to buy a property again. But he's actually, because of that, he's asked, your last time, Mark, you mentioned to pay the P&I or make a lump sum payment back to the bank to reduce the risk. However, it would be hard to get the money back from the banks later on down the track. Used to be easy. How do you manage this, and can you explain a bit more how to apply for the top up again? So I don't know if you two chaps have actually answered that question, because it's a lot harder now at 40%, obviously, LVR. But
I think Kris will answer that better than me. I definitely agree in reducing debt best you can. But it's all about leverage in your portfolio. So I think that's right up Kris's alley.
Yeah, so when I was talking about the triple CFA, to give you an idea of little changes that have happened, is if you want to restructure, we've got a client at the moment, for example, who's managed to get a 300k inheritance. To restructure part of his fixed mortgage into a revolving credit now means he's got to go through a full application process, provide full supporting documentation, everything. Now, from a common sense point of view, that doesn't work for me. Fundamentally, I think the customer should be able to change it over, throw his cash in there, he saves interest immediately. Let's just make the thing nice and simple. But because of this legislation that's gone on behind the scenes, clients are having to go through more and more of I suppose, these kind of hurdles. So yeah, it's just be aware things are getting harder.
Okay.
I mean, if you're putting your money in, just be aware there's a good chance you're not going to get it back easily, I suppose, would be my answer to that.
Yeah. A question to Kris. We've seen the rise of things like Afterpay and those sort of things. And what effect does that have on people's borrowing power with mortgages?
The banks do view those pretty poorly, because it's kind of, I mean, well, while I suppose you can sit there on one side and say, well, a credit card to an extent in some ways is the same thing. Just the pure, the case of someone going out, not maybe having the ability to afford it, grabbing it, and then having to pay for it down the road. People, I suppose, financiers are getting more concerned about borrowers' spending habits, and just those type of facilities are concerning lenders more and more. So previously, we'd find the main banks wouldn't pay too much attention to the types of financiers that were being used. And now if you're using maybe one of the more third-tier financiers, that's probably an indication that maybe you can't kind of get borrowings elsewhere, and that's maybe kind of raising more flags than it used to. So we're definitely finding the banks are looking at those type of facilities, those type of transactions a lot harder than they used to. Yeah. So the banks are getting right into basically how people are spending their money. It used to be a case of run a pretty basic analysis, pretty close to the example I gave you on those calculators earlier, and they'd maybe just put in a pretty good estimate in regards to what your living expenditures were. They're now trawling through bank statements, adding up how many times you went to McDonald's, all that type of stuff, and they're really getting in depth into what your expenditure is. So if people have maybe a little bit messy spending habits, you'll find that basically you're going to find it hard. If you're self-employed and you don't have your books up to date, you're going to find it impossible. If you don't kind of pay all your bills on time, finance ain't going to be easy to get. So it's a time to understand you need to get more disciplined in regards to how you set everything up. Otherwise, it's just going to be a lot harder to get your hands on cash.
So the message is limit to your Maccas and maybe go to KFC instead.
Yeah, that's one of the places I plan on going as soon as we get out.
That's one of your Kris's favourite places. Yeah, we're missing that, Kris. Hey, I've just got a question. It would be interesting to see what Jarrod thinks, and I'm just a bit worried. Hopefully, in 59 seconds, this webinar is not going to stop on its own. But if it does, thanks for attending. But I'm hoping it's not going to. But I just had a question from Paul. What do you reckon will happen to Auckland rents over 2021-22? Interested from the your perspective, Jarrod, what you think?
Oh, they'll continue to rise. Yeah, I mean, there's the shortage is the key. Wages are rising. The economy's performing particularly well. Rents follow wages more than anything else. So if the economy is doing well, people are employed, and when wages are rising, rents follow. Quite often, people will tell you it's the other way around. It's not. You pass on rent increases to the extent that you can, and with the tightness of labour markets, how well our economy is performing at the moment, plus the shortage out there, rents will continue to rise, probably 3 to 5% over the next year.
Yeah. One for you, Philip. Yeah, we will put the PowerPoint presentation, all the slides through to everyone, so that's all good. In fact, can someone just clarify that you're all still there, because the time has said it's just gone up, but I think we're still live, aren't we?
Yes, we're still live, and we've got a few attending.
Okay, we'll just keep going. Another question here, actually. Do you see any change to the bright line test duration to encourage investors to release product back to the market? And I know that's definitely that's why a lot of investors aren't selling yet, because I think there will be a lot of property come back in the market when they fulfill their 5 years, I guess. So do you think that I can't see them changing any the bright line test now, can you at all, Jarrod?
No, I don't think so. They've spent so much time getting it to here.
Yeah.
A change in government, perhaps?
Perhaps.
I think they'd be more likely to change the deductibility probably than the bright line.
Here we go. Jarrod, we have super low OCR now, and it will rise to around 1.5 to 2 to control inflation. What will it settle it back down to as a normal OCR?
Yeah, you've said it. 1.5 to 2% we think is the new normal from here. So most of us will remember the old normal of sort of 6 to 7%, and then there was a few of you that might remember the old double-digit interest rates. Basically, interest rates have been declining for 40 years. Most of it's a demographic shift, and we think the new normal would be around that 1.5 to 2%. So again, interest rates are rising, but don't expect the 5, 6, 7% mortgage rates that you saw, 10 or so years ago.
Good. That's for sure. One which is close to my heart was the immigration is a question for Jarrod. What gives you so much confidence that we'll see strong net migration when the government has consistently signalled that it intends to keep a tight lid on immigration? It's one thing for people to want to come here, but they can't if the government won't issue visas. I guess another one I'll just chuck on that. Another one I'll chuck on that as well for you is with COVID around the country, people around the world, countries settling down and getting on with life again. Will some New Zealanders go back overseas?
Definitely. I've got 2 very close mates from school who came here in the start of COVID and have basically been staying here until the world opens up again, and they're heading straight back overseas. So we'll definitely see Kiwis leaving. We always see Kiwis leaving. What gives me such great confidence? I don't have much confidence at all. I don't have any more information than what you have or what Treasury or the RBNZ have. We just have to make assumptions as to when we think borders will reopen. Ours is that we'll see some sort of border reopening late next year, and then more of a border opening in 2023. The New Zealand Treasuries is a bit outdated. Their assumption is that the border starts to open from January next year. So there's a few assumptions that need to be updated, but we don't have any more information. We just have to make these assumptions in order to forecast.
Yeah. Here's one I just thought of. Interested what you think. Will the Rugby World Cup go ahead in 2 years' time? I've got to plan my finances.
I certainly hope so. And you'll just need a couple of jabs and a vaccine passport, and you'll be done.
You'll be gone.
Excellent. Great stuff. I can arrange all that.
You mentioned double-digit inflation and interest rates there. When I bought my first house in Australia in 1990, we had 26% interest. And what people tend to forget that yes, houses were cheap, but money was expensive, and now money and houses are expensive. So it's kind of gone the other way. We were paying a heck of a lot of our income in pure interest at 26%.
Yeah, I'm glad those days don't seem as though they'll ever come back. Paul just asked me, but I like having these experts on here because, especially you've just been down there, Jarrod, I think. What's my opinion on Invercargill city centre with its massive new development on the inner city? Is that a potential new hotspot? I haven't got a clue of that answer. I know Invercargill was a lot of investors brought down there 10, 12, 15 years ago. It was very cheap, very good cash yields. Invercargill as a city's done really well over the decades from what I know, limited knowledge about it. You've been down there recently, have you at all, Jarrod?
Yeah, I went down Invercargill for the first time in my life recently, and I jumped off the plane. And I was a little bit excited, just quietly. I'd never been down there before. Jumped into the taxi, said to the taxi driver, I said, "Look, this is my first time down Invercargill." I said, I'm a little bit excited," and he goes, "You haven't missed anything." That was his response. So I know nothing about investing down in Invercargill, but I know the taxi driver for a good laugh.
Yeah, Albert Monroe put it on the map, didn't he?
All good. I think we've covered that one.
What's your opinions on Christchurch, Jarrod? Because I wouldn't say I know Christchurch at all, but I just noticed there's a few pundits who seem to think that that's one of the potentially better areas with just I suppose some of the factors. It doesn't seem to have the same price growth as some of the other major centres and stuff like that. I did notice on your heat map that it was still right up there. What's your opinions on that over the next couple of years?
Oh, look, I think Christchurch is quite exciting. I've spent a lot of time down in Christchurch over the last 3 years since coming home. The city's changed. It really has changed, and it's pretty. I like a lot of the residential stuff they've got close and in the city. It's really vibrant. There's little areas that remind me of Auckland's Viaduct and down in Wellington as well. They've got those cool areas set up. Beautiful city. We've been involved with a number of developments in Christchurch, and they've all gone very well. So yeah, no, I think Christchurch is a really good city. I mean, obviously it's come through a very horrendous period, but they seem to have done a pretty good job, I think, at least from an outsider's point of view.
Well, so we're all good people, were born and bred there, of course, but no, it's a beautiful place, and the city's getting better. Yeah, it's like a class as a really funky place down there. It's a beautiful place now, and going to get better and better. And it's still, I've been saying it's going to take 10 years now, but it's probably still going to take another 10 years, but it's still looking really good now, and some really nice parts of the market there. I was saying this time, probably about 10 months ago, that Christchurch has to go. It hadn't moved for such a long time. There were a lot of sales of it a year to 3 years ago. No one really realised, and not many people realised there were so many sales happening, but the prices weren't going up. And when all of a sudden Dunedin was about $100,000 higher than Christchurch, sorry, any Dunedin people, I didn't think that was quite right. But since probably October last year, it has gone up immensely. The price of property there, and new builds have actually gone up considerably, probably more so than Auckland on a percentage-wise in the last 6 or 8 months. Haven't got any data to back that, but I'm pretty damn sure that that's the case with new builds. But the market's going really well. And again, like, the one thing is, Jarrod alluded to early on, this is so different than the late 2000s, mid 2000s, where the whole country is a shortage of property, and the whole country is hot. And last time when there was a big fall in 07, 08, 09, there was a lot of parts of the country dropped considerably. But I think infrastructure is so big around a lot of the smaller town New Zealand from what it was 15, 20 years ago, and there's a lot of good reasons why all these places are going to do all right for a while yet.
This working from home phenomenon changes the game. Absolutely changes the game. People willing to work, for companies like ours, but you don't actually have to be based in the Auckland CBD anymore. Why not go live in paradise somewhere and still do your job? We're finding more and more people wanting to do that. Get out into the regions.
Well, I might just add, of course, that the Eastern Bays is paradise. So, Mark, I've just got to ask.
I'm in the Eastern Bays right now.
And so I've got to ask you one question, Mark. Crusaders or the Blues?
Oh, Crusaders all the way. Absolutely, 100%. I'm just trying to find a slide from a Crusaders supporter actually down there in Blenheim. It just asked Jarrod if I can bring up your slide on the regions and the growth and the value over the last 10 years. What one's that one? Do you know?
That would have been about slide 8 or something like that. I can't remember where it is on your pack.
There we go. Where are we? No.
There it is.
Oh, that one there, was it?
Is that the one?
So growth in the valley. Oh, that was how hot it is. No, that's the one with the growth, the actual growth in that region. So I should remember. I mean.
Oh, okay. In the house price growth. Sorry, I keep going down. There's a few slides there. You need to go into the housing section.
Oh, in fact, just passed it. Rest of New Zealand.
Next one. No, keep going. Keep down. So there. Go back up. Back up. That one there.
Oh, there we go. Yeah, that was the one he's after. And this gentleman's the.
So Auckland went flat for a while, which was interesting, and then took off.
When I first moved back to Auckland, it was January 2005, and it was just about 6 months after I was here. It was what was then one of my hottest markets that I've ever seen. Nothing that's still worse now. But yeah, it was played flat for quite a few years until probably.
And that was those LVRs. If you remember, they came onto Auckland first.
Yeah, the LVR stopped it immediately, and Hamilton market also. I remember most of New Zealand it stopped it more so than this time. Yeah, that's all good.
But it's been places like Hawke's Bay and Gisborne, that yellow line. I mean, just look at the state of it.
Yeah,
it's just under the green line, and bang, it's almost vertical, isn't it?
Yeah, I mean Marlborough's not on there. I know Blenheim's gone up 40% in the last 12 months. That's insane.
Yeah.
But yeah, Hawke's Bay, that's insane too. Look at that, geez. Yeah. Jarrod, what do you see the 1 year rate being in 2026?
2026.
4% question mark. Will the 5 year rate be higher?
It'll be higher. So what's the 1 year rate at the moment? 2.8, something like that?
2.5.
So 2.5? Oh, I think the 2 year rate, I know. Yeah, I would say it would be closer to 4.
Yeah.
All things going well, probably 3.5.
Well, if we're still doing that, we're all doing pretty well, aren't we, as investors? If that's the case, in my humble opinion. Yeah. I don't
Do you
know.
think those capital adequacy changes, which obviously were put off this year, Jarrod, are going to have much of an effect when they come in?
Yeah, that's a slow burn, mate. It is. It's that's something that'll take us a few years to build into. We've done a lot of the work so far. There's a few things that, I mean, you mentioned what you would prefer the central bank to do. One of the things I'd prefer the central bank to do is risk weight mortgages better. So you could actually say, the risk associated with this loan, like an investor, is slightly higher. So have a slightly higher interest rate. The risk associated with this loan here to an owner occupier is slightly less, so give them a slightly lower interest rate. So play with the interest rates rather than the DTIs and other things.
And I remember seeing over in Aussie a few years ago that they had different prices effectively for both of the.
Absolutely, where I got that from.
But also for interest only and principal interest as well.
Absolutely, where I got that from. So I was working at CBA when we made all those changes, and it made sense to me. If you want interest only, fine, but you're going to pay 1% more. And people 100%. Still did it because they were, it still suited their portfolio, and interest is deductible over there.
Yeah, but it compensates the bank for the additional risk. Fine. Yeah.
It's pricing risk correctly. I get that, and I think that would help, and it would strengthen the market, but it's not going to put people out like the DTIs are.
100% agree with you.
Yeah.
Well, I think we've kept always you guys for a good time tonight, a good period of time, an hour and a half, and there's one last week question there, and I think we all four of us should answer individually, our own little opinions. And it's what is the forecast of property prices in 2022? So I reckon we start with the biggest expert of us all, Jarrod. You go first. And then
2 to 3%.
What's that?
I'll say 2 to 3%. The end of next year. We've had 31% this year, 2 to 3% next year, and that's a pretty good outcome.
Yeah. Okay. Kris?
I'll be very close to Jarrod, but maybe maximum of 5, because I think those DTIs are going to completely pull it in.
Yeah, I'd probably say similar. Yeah, now I'm bailing out, aren't I? It looks like I'm bailing out. But
I was going to say 20.
2023 is probably for me the more of the worry, where I'd say flat. But yeah, between this year and next year, I still see a little bit of an increase. I'll go 6 just to beat you, Kris. But between there and 2022, what about you, Pete? And you can finish up.
Oh, I'm going to disagree with you all because I can. The problem is supply, and as long as there's an economy with more demand than supply, you've got increasing prices. So I still believe that house prices, depending on the area, will go up by over 10%. I believe that first-time buyers especially are still going to see an increase. There may be some offset there because of the investors selling second-hand properties, but around the Eastern Bays and the region, I do think that they'll go up because of the lack of supply.
Yeah, I probably agree with, as in there's still be a lot where the market's all hot everywhere right now. There will be quite a bit of difference in the market of different places around the country, and also different parts of each city also. I think where that'll start next 18 months to be, some will still be hot, some will be flat sort of thing. So
I think one thing that's going to make
you think everyone finish it up?
Yeah, one thing that I think will make a difference is when the new council valuations come out, because the CVs haven't changed since 2017, and they were meant to change last year. Then they were going to change this year, so I'm not quite sure where the council's at with that, but I do think that that'll make a bit of a difference. As to how much, I'm not sure. So anyway, thanks so much for everybody coming along on this rainy night. Or actually, it's quite fun right there now. And I hope you've enjoyed it. Of course, this is going to be available as a recording, and also the slides can be sent to you as well. Don't forget, Eastern Bays Property. If you go to our Facebook page, we're on Insta, all that sort of thing. You could find us also if you phone Mark on.
Marketpropertyventures.co.nz.
And your phone number?
021 402 990.
And you can get a hold of me on 027 663 0765. Those numbers will be sent out to you with this recording. So, Jarrod, Kris, Mark, thank you so much for your attendance tonight, and some incredibly valuable information there. And as I say, everybody will get a copy of this webinar, and hopefully there's more to come.
Thank you.
Really good. Thanks, team. Thanks for your efforts.
Thank you.
Okay. Thanks, guys.
Thank you.
See you, folks.